US banks have flipped. They are going all in on crypto and tokenization, and what Michael Saylor just said confirms a massive shift underway. We also have new updates straight from Ripple, including 4 major acquisitions with one clear objective. There's a lot to cover, so let's begin with Michael Saylor. He explained that for the world to embrace crypto, especially Bitcoin, in 4 to 8 years would be considered fast. But what we're seeing now is happening even faster. Major U.S. institutions like BNY Mellon, PNC Bank, Citibank, JP Morgan, Wells Fargo, Bank of America, and Vanguard have all flipped from hostile or skeptical to openly positive, and all within the last 12 months. We now have official announcements. Schwab is preparing to custody Bitcoin and offer credit against crypto assets early next year. Citibank is doing the same. A few years ago, it was impossible to get a loan against Bitcoin from any major U.S. bank. Today, 8 of the top 10 banks in the country are already involved in crypto lending. They shifted their stance in just 6 months. So what does this mean? If you hold crypto today but don't want to sell it, maybe you want to buy a home or make a major investment, you will soon be able to walk into the biggest banks in America and use your crypto as collateral for a loan. That's the financial system we are entering. A world where holding digital assets becomes an advantage rather than something banks try to suppress. It's remarkable to watch 8 of the 10 largest banks rushing to offer crypto-backed products. The speed is shocking, the scale is shocking, and the implications for the next 12 to 24 months are huge. Before we go deeper, here's something important. If you're serious about positioning yourself ahead of this shift, not guessing, not hoping, but acting with the precision the top 1% use, then you need to be inside XRP Insider's elite. This is where the real edge is. You'll unlock weekly XRP Insider alerts, advanced positioning frameworks, and the exact strategies used by sophisticated capital before the crowd notices anything. If you want to think sharper, move sooner, and stay ahead while everyone else reacts, this is your moment. Invest in yourself now. Everything you need is in the video description. Now let's take a snapshot of what these banks are actually doing, because it's one thing to talk about adoption. It's another to look at the evidence. The largest global banks are becoming active in tokenization, CBDCs, and regulated crypto access. Depending on their regulatory environment, they move at different speeds, but the direction is identical. Digital rails, on-chain settlement, tokenized value, and programmable money. Look at JP Morgan. They launched JPM Coin, a US deposit token, on Coinbase's Layer 2, enabling live institutional payments on public blockchains for the first time. Not tests, not simulations, live payments. They also expanded their blockchain division, rebranding Onyx to Kixis, and built tools like Kinesis Fund Flow, which enables real-time settlement for private funds. This comes after they already executed large-cap repo trades, cross-border payments, and tokenized securities on permissioned blockchains. In other words, Wall Street has moved past experimentation. They're now building the pipes for a fully digital financial system. Bank of America followed with a major policy shift in 2025, recommending a 1 to 4% crypto allocation via spot Bitcoin ETFs for suitable portfolios. It always starts with Bitcoin because of its liquidity and relative stability. But once institutions open that door, capital expands into assets with utility, assets built for real settlement, like XRP, Ethereum, and Solana. That flow is coming between 2026 and 2027. The positioning has already begun. Now zoom out to China. ICBC, the largest bank on earth, has a mandate to build smart banking powered by blockchain, artificial intelligence, big data, and IoT. China is the perfect example of the global pattern. Governments want the technology, the control, the infrastructure, but they don't want retail to get wealthy too fast. That's why China embraces blockchain while banning crypto trading. That's why certain countries restrict retail access. That's why XRP was delisted in the US for years. The system protects itself. When you don't have money, they control you. When you do, you control yourself. That's the real fight. Agricultural Bank of China is integrating with the digital yuan pilot. China Construction Bank and Bank of China are doing the same, building CBDC infrastructure, cross-border rails, and tokenized settlement layers. They don't allow citizens to accumulate crypto, but they are building the back-end rails that will dominate the next generation of finance. Shift to Japan. Mitsubishi UFJ Financial Group issued Japan's first blockchain bond. They also tokenized an $80 million Osaka skyscraper into digital real estate investment products. Tokenization is not theory, it is live. HSBC is expanding blockchain custody and expects tokenization on public chains to explode within 2 to 5 years. BNP Paribas continues building tokenized bond and fund infrastructure. Citi is expanding its tokenized deposit and programmable payment services for major corporations. These are trillion-dollar institutions rebuilding global finance. And here's the twist. Many were comfortable with Ripple when Ripple stayed in its lane. But now that Ripple is pursuing a national banking license, the tone has changed. Banks want Ripple as a partner, not a competitor. A banking license positions Ripple directly against JP Morgan, Citi, Wells Fargo, Goldman Sachs, everyone. So yes, there is resistance, but momentum isn't slowing. Even BlackRock confirmed that multiple sovereign wealth funds, literal nations, are buying Bitcoin at $120,000, at $100,000, at $80,000. They're building long-term positions because they know what comes next. Meanwhile, in the US, the CFTC just approved the first government-backed spot crypto trading platform. This is the regulatory green light. The Wild West phase is ending. Institutions want safer rails, better standards, and infrastructure that prevents another FTX-style collapse. They're finally getting it. What makes all of this even more fascinating is the speed. Analysts expected tokenization and institutional crypto adoption to take a decade. But when JP Morgan, Citi, HSBC, MUFG, Bank of America, BNP Paribas, and others all move together fast, it stops being a trend. It becomes a coordinated global pivot. Publicly, banks pretend these are pilots. Internally, they're clearing, settling, tokenizing, and restructuring the global monetary system right now. JP Morgan is the perfect example. JPM Coin started as a small settlement tool. Today, it moves billions across public blockchains. They expanded KYCs, activated tokenized securities, built real-time fund flow systems, and integrated across multiple chains. Banks aren't adopting crypto because they love innovation. They're adopting it because the old system cannot handle the speed and volume required by a digital economy. The winners of the next decade will be the institutions whose infrastructure operates like the internet, instant, automated, programmable, and borderless. Everyone else gets left behind. Now this leads us directly to Ripple's strategic evolution. Ripple is no longer a payment corridor company. It's no longer just the XRP company. It is becoming a full-scale digital finance infrastructure provider, the backbone for global value movement. Their recent acquisitions make that clear. G Treasury is the most important. This 40-year corporate treasury giant serves some of the biggest companies in the world. By acquiring G Treasury, Ripple didn't just buy software. They gained direct access to global corporate finance. Treasury teams manage trillions daily: liquidity, FX, investments, repo, internal transfers, compliance, risk analysis, everything. Before this acquisition, Ripple could help banks move money. Now it can help corporations manage and optimize financial operations end to end. This is a $1 trillion opportunity. Rail, the stablecoin and payout infrastructure, solves another massive pain point. Most companies don't want stablecoin custody, crypto bank accounts, or blockchain operations. Rail hides all of that. It provides simple APIs for global payments across fiat and digital rails without changing treasury workflows. Invisible blockchain wins at the enterprise level. Next is Palisade, Ripple's expansion into institutional custody. Institutions demand ultra-secure custody that integrates with payments, liquidity, compliance, and treasury. Palisade provides exactly that. Without world-class custody, nothing works. Tokenization, settlement, liquidity, automation. Ripple now owns this foundation. Then comes Ripple Prime, the prime brokerage layer for institutional digital asset trading. Combined with custody, payments, treasury, and liquidity, Ripple now controls every layer of institutional digital finance. This is why banks are nervous. Ripple is building infrastructure that mirrors traditional finance, but faster, cheaper, more secure, and more efficient. With a banking license, Ripple becomes the bank, the infrastructure, the liquidity provider, the settlement engine. XRP becomes the liquidity rail supporting that system whenever needed. Banks were comfortable when Ripple was a vendor, but Ripple has evolved into a competitor, one with superior technology. Meanwhile, sovereign wealth funds are quietly accumulating crypto. Pension funds and endowments will follow. The CFTC's approval of a regulated crypto spot platform signals the true beginning of institutional market structure in the US. And now, let's dive into something nobody is talking about: the second layer beneficiaries of XRP liquidity routing. Everyone focuses on banks and exchanges, but the real alpha is in the infrastructure that activates once liquidity thresholds are met. We are hitting those thresholds right now. Corridor spreads are tightening. Market depth is increasing. Slippage on test rails is dropping. Institutions are moving in synchronicity as if they were waiting for a signal, and that signal has now arrived. Recent liquidity tests in specific corridors suggest central bank level involvement. Settlement windows have tightened. Latency has dropped. Automation triggers have synchronized. These are signs of system activation, not experimentation. At the same time, ETF inflows are shifting from early hype patterns to disciplined institutional accumulation. Derivatives markets are aligning, open interest rising, strike clustering forming, leverage favoring longer timeframes. Options traders, real ones, are positioning for a structural shift. These signals don't come from hype. They come from infrastructure stress. The global financial system is cracking. Legacy rails can't support the speed we now require. Regulators know this. Institutions know this. Infrastructure providers know this. They're preparing not because they want to, but because they have no choice. When you see cross-border settlement migration, automation shifting to digital liquidity providers, and capital gradually routing into on-demand rails, these are not coincidences. These are system-wide indicators. Historically, when this many indicators align, it means a reset event is approaching. We are entering a phase of extreme information divergence. The public will know only what has already happened. Institutions will position for what hasn't happened yet. A small minority, tracking the right data, will understand the shift before it arrives. Liquidity cycles, consolidation patterns, supply compression, all of these match pre-parabolic conditions. Not hype-driven, but infrastructure-driven. This is how XRP transitions from speculation to infrastructure. When that happens, everything changes. Price discovery, capital flows, market structure. We are standing at the beginning of that transition now. It isn't loud or dramatic, but the signals are undeniable. Liquidity deepens, corridors activate, settlement windows shrink, automated routing optimizes. This is the era where XRP is driven by utility, not speculation. That's where asymmetric opportunity lives, and that's where the next major revaluation begins. All of this leads to one final element: timing. Institutions don't move randomly. They move in structured cycles aligned with regulation, liquidity windows, quarterly positioning, and macro stress triggers. Right now, all four are converging. That does not happen by accident. So the real question becomes, are you positioned before this next phase begins? Or will you react only after it's already unfolded? And again, if you want to stay ahead, not chasing narratives, but acting with precision, then you need to be inside XRP Insider's elite. Weekly alerts, advanced frameworks, and the exact positioning strategies used by top-tier capital. Move smarter, move faster, and stay 2 steps ahead. Everything is waiting for you in the description.